Hey everyone, I just saw a video titled Warren Buffett is never wrong. And I had to stop scrolling. Never wrong? Really? Okay, look, I respect Buffett enormously, beyond any doubt. Obviously, he is one of the greatest investors of all time. But saying anyone is never wrong is exactly the kind of dangerous thinking that will cost you money in the markets dearly. Today, I'm going to show you why treating any investor like an infallible guru is a recipe for disaster. Let me dive into Buffett's current $325 billion cash position. Let's analyze it, what it really means, and most importantly, why you need to think for yourself instead of blindly following anyone's moves, even Warren Buffett's, okay? And stick around because I will share 3 specific examples where following Buffett's moves would have actually lost you money. Plus, I will explain why what works for a $1 trillion conglomerate might be completely wrong for your portfolio. So let's break down why absolute statements like never wrong are dangerous, especially in finance, where the only constant is change. All right then, let's get started.
Warren Buffett's cash pile just hit another all-time high, reaching a record $325 billion. So today, Berkshire Hathaway, Warren Buffett's holding company, is storing $325 billion worth of cash on the sidelines.
And it sounds like it's a lot, but in reality, it's not. It's like such a massive company that's invested in so many assets that it's just a portion of it. But I'm sure he's going to talk about that too.
For a company whose sole purpose is to be allocating capital to stocks, this is a concerningly high allocation to cash. And many interpret...
Wait, that's not entirely correct, because Berkshire Hathaway has transformed a lot into sort of an insurance type of company too. Look, the way Warren Buffett and Charlie Munger always made their decisions was not to foresee some sort of economics. They're actually not friends of that at all. But they want to invest money in good businesses and businesses that have, a good value for the price that they're trading at. And at the moment, for Berkshire, in their analysis process, insurances are that for a very big part. And insurances need cash reserves. So Berkshire has a lot of cash reserves. So maybe he's going to talk about that. I don't know, but I just wanted to put that right in here out of the gate.
This as Warren Buffett's way of preparing for a significant market decline. That somehow Warren Buffett is aware of a large economic downturn that's on the horizon and that he's hoarding as much cash as possible in preparation for it.
Not necessarily. No, absolutely not. And actually, whenever he was asked, he said no, I don't do that.
Over the last 30 years, Berkshire Hathaway has returned about 2,100%, while the S&P 500 index has only returned about 800%. So Warren Buffett...
Wait. Okay, correct. However, in the recent years particularly, Berkshire has not outperformed the S&P. So again... This is not, the accurate information reflecting here. It's how can I say, one-sided way of looking at it.
Its investment decisions have enabled him to outperform the S&P 500 on a consistent basis over the last 3 decades, something that 85% of professional money managers are not able to do. So yes, Warren Buffett's decisions are definitely worth paying attention to. But
clearly, he is the GOAT, but of his time. That's very important, guys. There's a German saying, if you don't go with time, you go with time. What it means is that if you don't adapt and evolve with the changing landscape of time, you will become, basically time will melt you away. So it's important that you understand that. Just because someone has been the GOAT in something doesn't mean he will always be continuously the GOAT, because the environments have changed, okay?
Berkshire Hathaway's cash pile has been growing consistently over the years. Since 2012, his total cash pile has consistently been making new all-time highs almost every single quarter since. There was a brief exception in...
Yeah, but have you seen the expansion of the monetary, of the liquidity, the global liquidity? Come on, guys, this is like nonsense, because the amount of money, the total cake has grown so massively over all these years. And then naturally, his cash position will also grow or the size of his business. It's just, a consequence of that.
In 2022, when Warren Buffett reinvested part of his holdings into the stock market, but since then he's been resuming his ramp up in cash allocation. Now, part of the reason...
Yeah, because for him, he simply didn't find good businesses at cheap prices that he would want to invest in big.
For this is that Berkshire Hathaway is not at all the same size it was 20 years ago. In 1997, Berkshire Hathaway's total market capitalization was $50 billion. Today, its market cap is $1 trillion. So we can't just look at the total cash allocation to understand what Warren Buffett is doing. We need to look at his cash allocation relative to the size of all of Berkshire Hathaway's holdings in percentage terms. And today, that cash allocation stands at about 30%. Berkshire Hathaway's total cash holdings represent about 30% of its total portfolio. And we can see how his cash allocation has evolved over time. Going back to the 1990s, Berkshire Hathaway has indeed never held this much cash relative to the value of their total assets. So in other words, we've never seen Warren Buffett be invested in the stock market to such a small extent as today, which effectively doesn't suggest he believes the stock market looks particularly attractive today. But does this mean that he is preparing for some kind of black swan event?
No mention of the insurance business. Why? Does he not know, or does he not want to show that side? I cannot answer that question. Also, a black swan is by definition an unknown. Nobody prepares for an unknown, because if you prepare for an unknown all the time, you can't do anything. So nobody prepares for a black swan. You do risk management, you do scenario analysis, you do, you have a clear plan of what you do, when, what happens, but you cannot prepare for something that you don't know, right?
Or that he has some foresight into the next recession? Well, the last time that Warren Buffett had a particularly elevated allocation to cash was between 2004 and 2007, a 3-year period where his cash allocation stayed quite consistently above 20%. Soon after, the 2008 financial crisis occurred, and that's the moment where Warren Buffett finally began to reduce his allocation to cash again and reinvested his holdings into stocks once the crisis.
Yeah, he exited businesses where he thought they were overvalued from a price perspective of what value they were given. And he did the same recently also, for example, with the bank industry. He exited a lot of bank stocks. Probably, and this is what they say, it's because banks have a ton of toxic bonds on their balance sheets. So he said, okay, I don't want to get involved with that kind of business. Doesn't mean that this will create a recession, and particularly the Fed, the US government, and now all the change after the election, all of these forces will work tirelessly to avoid that from happening anyway. But that's a different conversation. But exiting certain asset classes or businesses or industries or sectors doesn't mean he's foreseeing a black swan or a recession or a crash, okay? His point of view is, I want to invest cash in good businesses. And if the good business is overvalued at good prices, then he's just reducing his exposure. That's risk management.
Had passed. Many people point to this episode as a sign that Warren Buffett knew something that others didn't about the US economy. But when we look at this episode more closely, we see that it's very unlikely this was the case. His maximum cash allocation was reached in December of 2004, 3 full years before the onset of the financial crisis. And as you can also see, Warren Buffett was already reducing his cash allocation.
So you're going to tell me, the Oracle of Omaha, look, again, the guy is a goat. I have massive respect for him, and obviously his success speaks for him. But he and Charlie Munger said, the only thing you do is you buy good businesses at cheap prices and you sit tight. That's their strategy. And you don't bet against America. So, again, that is not knowing that the real estate bubble was going to burst years later. He didn't do the Michael Burry because he didn't take bets on it neither. And he got and saved the day in the financial crisis of 2008 because he had cash, yes. And then he saw an opportunity to get into businesses at cheap prices that the government would support as well. So it was a win-win.
allocation in 2005 and 2006 before the 2008 recession began. This really doesn't make it look like he knew anything about the future of the US economy.
He did.
In fact, Warren Buffett has never pretended that he had any foresight into economic trends. In fact, he's just simply not a fan of economics as a profession.
I can't recall ever us making an acquisition or turning down one based on macro factors.
So if he doesn't believe in...
And honestly, guys, a lot of economics is pseudoscience. And the more you start to study that and you see what kind of monetary expansion experiment times we're living in, removing from the gold standard, having no hard real money, having all these increasing levels of debt and all these things, you will understand that the economics or the science of economics is anything but a real science.
timing the economy or market, how come he is building so much cash today? Well, if you've read Warren Buffett's holy grail investing book, The Intelligent Investor, you'll know that Buffett's current cash allocation actually makes a lot of sense, and it doesn't at all revolve around predicting what the market is going to do next. It does revolve around having more exposure to the stock market when it is cheap and having less exposure to the stock market when it is too expensive. Today,
Correct.
the US stock market is expensive to say the least. The S&P 500 PE ratio, which is a metric that Warren Buffett does pay close attention to, is currently hovering at levels that have only been seen briefly in 2021 and more importantly in 1999 right here. So making the stock market today about as expensive as it's ever been over the last 40 years. But it's not just the S&P 500 as a whole that's expensive today.
That overstretched PE metric is old news. You know, we're dealing with a very vastly different economy than we have been ever in the past. Have you heard of the internet? Have you heard of the digital world? Have you heard, of the profit margin of digital companies? Have you heard of Meta? Have you heard of Google? Have you heard of Tesla? Of AI? Have you heard, and now obviously also of blockchain and all of these things? They have impacted these metrics to a huge degree. And this is exactly what I'm actually my biggest critic on this type of argument is that, look, the market is forward looking. You cannot, invest in the past. Investing is always in the future. You got to sell the past and invest in the future. And if you only look at these old metrics and you don't discern and understand why and where they apply or not, then you're going to believe this stuff. I don't.
Today, pretty much every sector across the economy is at historically expensive levels. This is a chart of the PE ratio of financial stocks or banking stocks that are, again, about as expensive as they've ever been. The same thing for industrial stocks and for material stocks that have only been...
Yeah, but that also has to do with liquidity and inflation. And, as money or cash is trash, let's just say, and we had all this inflationary pressure, where should the money flow into? You only can go into the stock market or real estate or now, right? So Bitcoin, obviously. But that's, again, another conversation. So that's why stock markets on the long term always go up. And I would never, ever, ever try to time a market crash and try to short it. You will lose 100%. Yes, sure, keep some powder dry and be a dip buyer when the opportunity comes up. I think that's a valid strategy. And to assume that these levels are in, comparison with history high, yes, that's not a wrong information all by itself. But to assume that something must happen because of that, then you're just ignoring the fact of extended liquidity, other profit margins, interest rates. Like there's so many, this is an oversimplification of just looking at things. This is not correct.
This expensive a handful of times over the last 30 years. So almost the entire US stock market is expensive today. Warren Buffett's philosophy is to...
Yeah, but also all the world invests in the US only. Tell me one other stock market in the whole world that comes even close. Not even Europe. Let's see, anyway, Europe has crashed and trashed its economy in the recent years, but no other stock market is investable. The capital structures, the liquidity, the innovation, like all of these things, also the legal structures. So the whole world has earned more money over the last decades and has invested more money in the US stock market mainly. Got it? That's why it went up.
Buy great businesses at cheap prices.
Correct.
So with today's market pricing across pretty much every sector of the economy, he's probably having a difficult time finding interesting opportunities. On the other hand, the yield that you get for holding cash is hovering at around the highest levels of the last 30 years, making it an ideal investment for cautious investors in today's expensive.
Two things again. He has the insurance business. He got to keep cash on the side, and he's getting well paid to have cash on the side. So why in the world would he not do that? He's not predicting a crash. He's leading his business in the most, efficient way, in my opinion at least.
Market. In fact, this is also an integral part of the intelligent investor's philosophy. When the yield that you can expect from cash is higher than the yield that you can expect from holding stocks, this book suggests that investors should significantly decrease their allocation to stocks and increase their allocation to cash instead. And today, that's exactly the situation that we are in. This is a chart showing us the spread between the S&P 500's earnings yield and the yield that you get on cash. And today it's hovering at some pretty negative levels. We've only really seen this happen.
Yeah, but earnings is again another thing. Earnings alone are not the decisive factor. Like you have companies that are growth stocks and they go up by buying their own stock. So there are other dynamics or more dynamics here at play. This is again a very one-dimensional view on the reality of what is actually driving all these things.
8 times over the course of the last 60 years, and these are the episodes that you see marked here. And what is fascinating is that when we look at what these moments correspond to on a chart of the US stock market, we see that most of these have corresponded almost perfectly to a significant peak.
And all of these were before the financial crisis in 2008, before we have infinite QE, before we had the internet economy, and before we have all the world that we live in today.
Peak on the S&P 500, and that includes the peak right before the 1987 Black Monday crash. This is simply because a high cash yield versus a stock market yield means that investors are less likely to allocate capital to the stock market and more likely to store away cash and save up. And so this naturally leaves the market more vulnerable to seeing a large drop. So how come we haven't seen a peak in the market yet, despite this spread being negative for the entirety of 2024? Well, that's where we once again come across some similarities between today and the late 1990s. Right here, you had a similar combination of an expensive stock market despite a very attractive yield on cash. And this environment lasted for multiple years. It's only until the 2001 recession happened that the stock market was brought back down to reality. And this set off about a decade of underperformance in US stocks. So
again, we have different times today. We have just the options market alone and the involvement of retail trading zero DTEs and the amount of internationalized investing into the US stock market, the expanded liquidity per se, and the more digital economy. All of these things show that today we have a vastly more let's just say a different situation compared to these recessions. Now, I'm not saying that a recession or a crash is not possible. It is possible. But if I look at the probability of it, and also like for a stock market to crash like that big, that quickly, we have the stock market will close before. You have market makers. You have the most liquid market in history. So there are a lot of mechanisms at play that have been created, that prevent markets from going down in the same extent and the same amount of time that they did before. Of course, this was COVID. And again, if this happened, then I'd be happily buying.
So a long-term investor who doesn't claim to be able to know what the economy is going to do like Warren Buffett is going to be building cash in this environment regardless of whether a recession is close by or not. But when a decline in the market eventually does come, he'll be deploying that cash back into the market. We don't have quite the same strategy at Bravos Research. We've been riding this bull market throughout the entirety of 2024 with many.
Wait. So, all this fear mongering. Oh, is Warren Buffett preparing for the biggest crash? And look, he's this oracle knowing it's gonna go bad and everything. But we have been buying the whole time. So what's going on? Like, this guy's contradicting himself. Like, or I don't understand the purpose of this video correctly. You tell me. Tell me in the comments. What do you think? Like, does that make sense? Come on.
Different trades. Most of the trades that we initiate on our website, we keep for about 1 to 3 months at most. So we don't really need a very long-term approach to markets. What we care about is whether stocks are trending higher today. And the reality is that is still the case.
Okay. I would be more interested in the reality of your trading results. That would have been a great opportunity to show your results. Maybe on a verified track record to not just talk about it.
But the moment where our indicators are suggesting that the uptrend is beginning to break down, we'll be going from net long to net short on stocks.
So alternative perspectives to consider for Berkshire's evolution are, look, the company's massive size, it just requires different strategies than in the past. And the cash position might reflect the lack of suitable acquisition targets at especially Berkshire's scale, right? And don't forget, the insurance float management is a crucial factor in cash allocation. And also don't forget market context. High interest rates, and they make cash a legitimate asset class. Like, why would you not use it? And the market environment is fundamentally different from historical periods. And technology and innovation is changing traditional valuation metrics massively. So you have to make strategic considerations. Large cash positions provide strategic optionality. So Berkshire's reputation for rescue deals requires available capital. And patient capital deployment has historically been a strength and not a weakness of them. So in a way, they are completely doing what they have always been doing. You know, while Warren Buffett's track record deserves respect, massive obviously, it is crucial to understand that Berkshire Hathaway today is a very different beast than it was decades ago. So the massive cash position is not necessarily about predicting market crashes. It's about the realities of running a giant insurance conglomerate in today's market environment. Okay? And instead of viewing Buffett as either always right or always wrong, this, magic guru thinking, we should see him of what he actually is. An extremely skilled investor, adapting to changing circumstances while staying true to his core principles. The real lesson isn't about following or opposing Buffett blindly, not even a little bit, but about understanding that different investment approaches can work in different contexts. It's very important that you understand that. And whether you are managing $1 trillion conglomerate or your personal portfolio, the key is finding a strategy that fits your specific situation and sticking to it. And this is what we learned from Buffett. So Warren Buffett's track record is extraordinary, but even the Oracle of Omaha isn't immune to market unpredictability. And he says the same thing about himself. But his strategies work for him, but they may not necessarily work for everyone. You have to understand that. The next time someone points to Buffett as the ultimate authority, remember, even legends cannot see the future. So should you follow Buffett's path, or better, should you carve your own? The choice, as always, is yours to make.